Welcome back, I'm Linda Kincaid. We'll call it the luck of the Irish on Wall Street. All the major US averages finishing solidly in the green on St. Patrick's Day. The Dow, the big winner, up almost 1%. And all this despite a weaker than expected read on US retail sales. Investors bracing for a busy week on the economic front. Federal Reserve policymakers deliver an updated policy statement Wednesday. Chairman Jay Powell will hold a news conference. No change in rates is expected. But the Fed will update its projections for rate cuts later this year and its latest growth projections for the US economy. Well, the OECD says in a new report that the Trump administration's trade war will hit global growth hard. The organization says US GDP is expected to rise 2.2% this year, not far from its previous forecast. But the main targets of Trump's trade policy will fare less well. Canada's economy is now expected to grow less than 1% this year. The previous forecast was for 2% growth. And Mexico's economy is now expected to shrink more than 1%. The previous OECD estimate was for growth of more than 1%. Well, David Kelly joins me now. He is the Chief Global Strategist at JP Morgan Asset Management. Good to have you with us.
Great to be here.
So this is the first major forecast looking at the impact of Trump's trade war. And it doesn't look good, does it?
Well, tariffs tend to, slow the global economy. I think, most economists believe that tariffs both increase prices, but also slow economic activity. I think it's too early to say just who are the losers in this trade war, but generally, everybody loses something. And if anything, I'd be a little bit more pessimistic than the OECD on the US outlook, given what we know about economic activity early in this year.
Yeah, it certainly, as it stands, said the two hardest hit nations would be Mexico and Canada. Just in December, the OECD suggested that the forecast of growth for Mexico would be between 1% and 2%. Now it's expected to fall into recession. And when you look at Canada, it was forecast to grow 2% for the next 2 years. Now growth could slow to less than 1%. I mean, certainly it doesn't look good for America's closest allies and neighbors.
Well, that's right, and that's because both Mexico and Canada depend a lot on exporting to the United States. But the U.S. is not getting off unscathed either. What we've seen, if you look at the retail sales numbers this morning, those are pretty weak. We're seeing a lot of weak survey data, which suggests there's just a lot of uncertainty between the tariffs, the government cutbacks, and other policies, and just no certainty about what sort of tax cut there may be in 2026. This is all slowing economic activity. I mean, I think it's too early to talk about recession in the United States, but we think that economic growth in the first half of the year will be close to zero. I think we may get a negative in GDP for the first quarter and maybe a small positive in the second quarter. But we've clearly seen a step down in US GDP growth, even if we're not hurt as much as Canada and Mexico.
But if all these tariffs roll out as expected from next month, is it more likely we might see a recession?
That certainly could happen, but we have to see what else happens. I mean, it's possible that the administration will pull back, recognizing the damage that these tariffs are doing to the economy. It's also possible that the Congress, in order to offset the effects of these tariffs, puts in more fiscal stimulus. So maybe we get bigger tax cuts, particularly going into 2026. Not good for the deficit, but it does compensate by adding back economic growth that we're losing because of the trade war. So I think it's just too early to say whether the US economy is going to end up in recession because of this. But as I said, the uncertainty about tariffs and tariffs themselves are slowing not just the global economy, but also the US economy.
And David, what does the latest data on consumer spending tell you?
Well, it does. It looks pretty weak. I mean, we saw a very strong fourth quarter, so we have to remember that. But we are seeing signs of pullbacks both at the basic levels. Things like restaurant sales, food sales were very weak in the retail sales report. We've also seen a big fall in consumer sentiment. So we're seeing some pullback by consumers. I wouldn't call it a crisis yet, but consumers are cautious. I mean, they realize that the outlook is a little less certain. So we're seeing some pullback there. Again, I think we're some distance away from this is not a 5-alarm fire yet, but consumers are cautious and have got a right to be cautious given the uncertainty in the economic environment.
And just quickly, what do you think we'll hear from the Fed on Wednesday?
So I think the Fed, like everybody else, is in a wait and see stance here. They have to wait to see what the end game is on tariffs, on government cutbacks, on fiscal policy for next year. So right now, I think they're on hold. I think they will increase their estimate of the number of rate cuts this year, maybe to 3 instead of 2. I think they'll raise their forecast of inflation, cut their forecast of growth. So they're going in the wrong direction here. But for the moment, they're just on hold because they, like everybody else, wants to wait and see what the end game here is on Washington policy.
Wait and see. They are the words. David Kelly, Chief Global Strategist at JP Morgan Asset Management. Appreciate your time. Thank you.
Anytime.
Well, still to come, anger among Democrats as leaders struggle to find their footing. A new poll showing that party approval ratings are at an all-time low. Can the Democrats bounce back? I'm going to speak to an Illinois congressman after the break. And taking Tesla to task, protests outside showrooms around the US against Tesla's CEO and the world's richest man, Elon Musk. We'll have an update on that story next.